Buckle your seatbelts. The roller coaster has started, and you can expect it will continue all the way into 2024. Last time we said that the market may drop sooner than the 25th of September, and we warned, based upon the patterns we were looking at, that it could start fairly soon, and it did. Now, what do we expect? Well, ultimately, very, very confident market's going lower. How much lower? On the deep end, I don't think it's going to be more than 15 to 20% from the most recent high. So I don't think this is a 1987 crash or a 1929 crash, not so far in terms of the amount of decline. The timing of the thing is going to be very similar. The up and down moves will be very similar. I think a more likely representation of what's happening is what happened in 1999, 24 years ago, where the market pretty much has been repeating the whole year. October 8th of 1998 matches the October low in 2022. The market rallied until late July back then. We had a high late July in this market. And the market's been doing pretty much the same thing. And you can see in this chart an overlay of the 1999 market on the present market. The present market is in red. Okay, so we're in the middle of a decline. It goes lower, it has a bounce, it goes even lower, but that's the end of the thing. That one ended October 18th, by the way. We're looking at the possibility of a low starting shorter term around the 4th of October and another one around the 18th of October. Which is lower? Probably the one on the 18th. If, however, we have a huge down day for whatever reason, some dramatic, giant 5% move in one day, I would be getting out of the position. Because this is a corrective move. It is not the beginning of a new bear market. Any huge decline here should be bought. And if you look at what happened in 1999, the market made a low in October, and it went up and up and up into January, even into March of 2000, which would match March of 2024. So we could see new highs for the year even after a nasty decline here in October. These are several examples of what we had been looking at. The 1929 market and where it is in its development, that one still has quite a bit of time to go, and will go gradually down into the middle of October. This other pattern, the 1987 market, has a few more days down and it's done. Then it chops around near the low for a while. The 1999 market, as we see, goes down until the 18th and then it shoots up. And on the top of the list, interestingly enough, the 1994 market is repeating extremely well. For the last 9 months, it's the best match. It's 90% correlated. That one also just has a few sharp days down, then it goes up and back down and up and back down. Any of those lows could be lower in this market than the first one. But it is possible that we'll see a low and then just another retest in October. So what am I saying? I'm saying stay short, but be concerned if you see a very large down day, not to get excited about going further short. Rather, you want to be getting out of the shorts. And also, on the late side, if it goes all the way till the end of October, that's beyond what we expect. All right, that's on that end. In terms of price, several obvious things. There's this uptrend line that you can see here on the S&P chart, and that trend line is at this point at about 42.80, and it's very likely to get hit. We also have a number of support lines on our matrix channel, which is an extremely reliable support and resistance model. And you notice that there are quite a few lines clustered right where we are right now, but we closed slightly underneath all of them. And then if it does go lower immediately, the next support level is in the 4150 to 4190 area, the next cluster. So these are important levels. And then on the extreme side, there is another possible support level that's generated by our momentum balance technique, which is saying that we could go to 3950. So if we went from 4600 to 3950, it's about a 15-17% decline. And then it would go up again. So we're looking at the timing angle in the matrix channel having triggered the exact high recently. You can see where the timing angle is going through the horizontal line, and it's exactly the price of the market, and the market started to decline from there. The timing angle is now in between lines, which means there's still room, there's still time before the next low and before the next major pivot. What's going to happen after that? We're looking for a rally into the beginning of next year. The end of this year, early next year, it's likely the last few months of this year will be bullish. And after that, the 2024 forecast, which will come out later, but just to give you a peek, we're looking at something similar to the year 2000, which was a year where the market started out with a big decline for a couple of months into February, had a rally into March, another decline into April, and then went nowhere until September. It was a sideways year. It was a setup for the following year. 2001, of course, was a big down year, but the year 2000 was just a consolidation year, preparing for the next bear market. 2024, the election year, I believe, is preparing for the next bear market in 2025, 2026, into 2027. Right now, we're still potentially even on the way up. We may not even finish rallying until the end of this year, and we may, if we have less than a 20% decline, we could make new highs for the year before the end. So, hopefully your seatbelts are on. Hopefully you have seatbelts. Use stop loss orders whenever necessary to protect your positions. Don't be too greedy. If you can make a huge profit on a down move, don't try to catch the bottom, because this market's not going to hang out. Once it hits the low, it's going to take off. And the options in particular, they'll decrease dramatically.